Hello and welcome to today's episode of Tax Matters. My name is Olumoyiwa Matuloko, and with me on today's episode is Christina Pius.
Hello viewers.
A few episodes ago, we brought you the story of a workshop organized by the Federal Inland Revenue Service Large Tax Office Oil and Gas Downstream on value-added tax and withholding tax collection and remittances. That office is one leg of the tripod on which Petroleum Tax Administration rests at the FIRS. On today's episode of the program, we will be telling you stories of two separate workshops organized by the two other legs of the tripod, upstream and servicing. Christina, it's your story.
On Thursday, 24th of July 2014, Large Tax Office Oil and Gas Servicing got together tax consultants, auditors, representatives of all servicing companies, and other stakeholders for a workshop on compliance with transfer pricing regulations by oil and gas servicing companies in a self-assessment regime. The head of the transfer pricing department, Mr. Matthew Godrumbola, was on hand to kickstart the interactive forum.
When we look at the oil and gas industry, we realize that the oil servicing segment or sector of that industry is very, very important. Those who are actually engaged in doing seismic surveys, those who are engaged in drilling the holes that are bringing the oil, those who are doing the wire logging and things like that. Now, we also all know that oil servicing companies are taxed under SITA for their non-petroleum operation income. What then do we expect? What does FIRS expect based on the law from oil servicing company with respect to transfer pricing? Transfer pricing is not a creation of the transfer pricing regulation. No. Transfer pricing issues, provisions had always been in our laws. Section 22 of the Companies Income Tax Act made it very clear, and whatever you see in that section is almost the same thing in PPTA, in PITA, in CGTA. I think it's only in VATA that is a little bit different. And what that provision is talking about is where there's a disposition between people that are connected, and such disposition are not in fact giving effect to, or there's a transaction that appears to be artificial. He said that the board this time around talks about the Federal Revenue Service, is at liberty to set aside such disposition or such transaction, or to make adjustment as deemed fit. We must know that transfer pricing itself is no crime. There's nothing wrong in transfer pricing. What the law frowns at is transfer mispricing. Whether you are buying from a connected person or you are selling to a connected person, as long as the price is arm's length price, you have not done anything wrong. But issue arises when it is discovered that you have actually mispriced such a transaction. However, the provisions we have in the law are limited. And that is why over the years we have not been able to actually put the provisions of the law into practice. So it is these shortcomings that we observed in the law, in the extant law, as at 2012, that led to the publication of the Income Tax Transfer Pricing Regulation, number 1 of 2012, which was published in August 2012. And it derives its power from the various laws that we have mentioned. And it's a complement to the existing legislation. It's not a law on its own. It's not a standalone law. But it is a complement to the provisions we have already had in our various laws. It commenced from 3rd August 2012. Effectively, that talks about 2nd of February 2014. So if your returns for 2014 year of assessment is due by 2nd of February this year, then, of course, transfer pricing issues that may be there must be reported. The rules apply to both cross-border and domestic transactions. That is, it can apply to a group of companies that are purely Nigerian companies, and also applies to those that are international or multinational enterprises.
Tax Controller, Large Tax Office Oil and Gas Servicing was on hand to welcome the participants.
Our experience on the field has shown that there have been serious challenges with companies operating in the oil and gas sector with respect to related and connected party transactions. Companies have varied arrangements with their sister companies, foreign and local, signaling transfer pricing issues. I want to state here that this has been one of the major issues that are of concern during our examination of taxpayers' returns.
Speaking in the same vein, Mrs. O.O. Adediro, Director, Land Tax Office Oil and Gas Department at the FRS headquarters, re-emphasized the importance of the servicing sector of the Oil and Gas Department.
The concept of transfer pricing is not limited to oil and gas sector alone. This we need to take note of. But for the peculiar nature of the industry, it is more echoed in this sector of the economy as a result of numerous forms of arrangements and agreements that subsist among related entities, contractors, subcontractors that are operating within the sector.
Mr. Gbodri's Bola's paper was followed by a robust interactive session.
I wish to know if any agreement has been reached so far with any taxpayer as regards advanced pricing agreement. And the last question is on the obligation of non-resident companies. Section 13 of CETA talks about different conditions that could, make a non-resident company liable to tax in Nigeria. And under subsection 2, it talks about a fixed base. And my question is, if a fixed base is created by an unrelated party in Nigeria, would that non-resident company still be obliged to comply with the TP regulation?
There is a date of the commencement for transfer pricing, which is August 2012. There are some transactions that the client may have had prior to this period. What happens to them?
The TP filing documents, they are quite voluminous and cumbersome. So, and most of the information contained there or required there is also in the registration for tax form. So I don't know whether maybe after this first period, in subsequent period, the disclosure forms can be made shorter or simpler.
As to the voluminous nature of the various forms, yes, we agree with you that they are voluminous, but I can also tell you that if you put the other, our forms side by side with some other countries, you will see that our forms are not voluminous at all. I don't know whether you have seen the TP form from Ghana and some other countries, Venezuela. Then you will agree with me that you have not seen a voluminous form. But again, let me also tell you that we are just starting. We are going to improve. As the taxpayers improve in their understanding and compliance, also the service will see the need to further make things simple and easy. And I can also tell you that we are already working on making an app that you can use in filling those forms. Lade wants to know what happened to transactions before August 2012 and which are still reported in the balance sheet. It doesn't even matter whether reported in the balance sheet or not. The regulation made it very clear that the commencement period for TP returns is going to be the day after 2nd of August, which means 3rd of August, which therefore means any transaction before then may not, I use the word may deliberately. No, deliberately I use the word may, and I will explain myself. May not be subject to TP review. Why I didn't use the word shy is because there are some transactions that span across number of years. And I give you an example. You've taken a loan in let's say year 2010 that will run for 10 years. The agreement, of course, will be 2010, isn't it? And by 2013, TP has caught up. So definitely, in reviewing that, the service may request for that loan agreement. Any APA so far, no. And we are not doing APA for the time being.
Every day, my people, they for work. Some they do office work. Some get it them own business, so all of them want good road, constant power for better life. Whether now office work, oh yeah, pay your tax. Whether now your own business, oh pay your tax. If you want a better life, oh pay your tax. Now your civic responsibility, pay your tax. Better soup, now money cook more. Oh yes. Nothing goes for nothing, my brother. If you want potable water, security and hospital for make life jolly.
That's right. Good roads, good hospitals, portable water, adequate security all come from taxpayers' money. Play your part in making Nigeria great. Everybody, small scale, big companies, entrepreneurs, do the right thing. Pay your tax. This message is from the Federal Inland Revenue Service, FIRS.
Welcome back. The program is still Tax Matters. Like we said at the beginning, we are sticking with the oil and gas industry. And you know very well that on Tax Matters, that can only mean oil and gas taxation. Christina, it's your story again.
On Friday, 6th of June 2014, another leg of the tripod of the LTO Oil and Gas Department of the Federal Inland Revenue Service, the Land Tax Office Upstream, organized a sensitization workshop on proposed income tax returns, template for production sharing contract parties, and the contract area. Again, Mrs. O.O. Adediran, Supervising Director of the department, played host to the sectorial stakeholders.
You will agree with me that since 2012, we had the mandate of the management to unbundle the SY oil and gas office, tax office, into 3 major offices, and we have 3 major offices in 4 locations. 3 of the offices are located within this building for your comfort, so that you can have your transactions treated in one-stop shop.
The coordinating director, Field Operations Group at the FIRS, Mr. Ajayi Bamidele, delivered the keynote address on production sharing contracts, corporate income tax filing obligations, FIRS perspective. To set the tone for discussion at the workshop, Mr. Bisi Babalola delivered a paper on corporate income tax obligations of petroleum sharing contract parties.
As far as the Offshore and Inland Basin Production Sharing Contract Act is concerned, there are 2 principal actors, NMPC or the holder, and the second category are contractors. As far as Nigeria is concerned, there are 2 corporate income taxes. The first one we call it company income tax. The second one, we call it petroleum profit tax. That is, a company, when a company is going to pay tax as a person, it can pay either company income tax, or it pays petroleum profit tax, or it pays both of them. Under what law will a company file returns? There are 2 legislations. One is Company Income Tax Act, and one is Petroleum Profit Tax Act. So who files under Company Income Tax Act and who files under Petroleum Profit Tax Act? Section 55 of CITA says every company, granted exception from incorporation, shall, whether or not a company, the company is liable to pay tax under this act for a year of assessment, with or without notice from the service, file a self-assessment with the CP at least once. In my opinion, that section actually has not exempted any company, no matter what you are doing. As far as you are a company, you have the obligation to file returns under CITA. That, when we talk about PPTA, what we now need to look at is the PPTA, where the profit of, which talks about taxing the profits of from petroleum operations. Has it really relieved companies that make profit from petroleum operations? Has it relieved them of the obligations to file under Section 55 CITA?
The bone of contention was the stand of the FIRS that companies in the petroleum sharing contract regime should file returns both under the company's income tax CITA and the petroleum profit tax PPTA.
With respect, I don't agree that Section 55 requires us the companies that suffer tax under PPT to file returns, because the emphasis here is not on whether you need to pay tax under the Act or not, but whether or not you pay tax under the Act for the year of assessment.
On section 55, one thing I want you to know is this. An accounting year of the company is defined. You agree with me? For company in petroleum operations, January to December. And basis period also is defined. Base period, year of commencement, the date of commencement December, first 12 months, and preceding year basis. So the basis, the assessment period that you are using in that act, the assessment year you are using is not easily determine your assessment year when you not started petroleum production. You get me? And you may not have tax to pay. The law is clear. You don't have tax to pay. Put it, I have a loss. I don't have income. You have complied. Are you getting me? But we are not out of point. But if we ask when you have not commenced productions or oil, because you have not entered into your first accounting period. First accounting period under PPT is defined. One, A says the first 12 months, January to December. Number B of it says the date of first commercial production and bulk disposal of oil under commercial quantity to December. That's one. And the other one is when you the date you cease from January to the date of cessation. Those are the accounting periods as defined in the Act of PPTA. So if you are not enter your first accounting period under PPTA, you are not to be subject to tax under PPTA. Let me also say this, that by asking that you file under PPTA, we are not saying that you should file two. If you have profit under PPTA, the moment you enter to PPTA profit, you are not going to be guided by PPTA Act to the extent that you don't have income that is subject to tax under SITA. If you have income subject to tax under SITA, you will still take it to SITA and file it.
The law is clear. A company formed with objects, and it happened to be the object of the company that is going to go into petroleum operations. So what happened first is that a company is formed and nothing is taken away from you, because if you don't have anything to pay bills. But we know that there can be other income that are not subject to petroleum profit tax. So which means if you are not filing CIT in addition to what you are filing, those income will escape tax.
At the end of it all, everybody went home happy.
This is a very good gathering in respect of petroleum profit tax. It's not petroleum profit tax alone, tax in Nigeria.
I want to thank the FRS for actually organizing this particular event. We are not going to get all the solutions here. Some of the things we need to take back, and then we need to discuss further. And then it's not about FRS against the company or the company against the FRS. I think we need to actually see it as a collaborative effort that what can actually work for all of us.
Welcome back. Christina, if you hear the word disco, what comes to your mind?
Music and a dance hall. But of course, under the new dispensation in the power sector in Nigeria, disco means something else. In the course of this last story on today's episode of Tax Matters, when you hear disco, please forget dancing. It means an electricity distribution company. We all have one in our area. Genco means generating company, and Transco means transmission company.
In recent time, the Federal Inland Revenue Service has stepped up its game in the area of automating collection of value-added tax from the consumers at source, that is, immediately after transaction. This has been successfully done in two major sectors of the economy, banking and aviation. And of course, as you know already, government agencies, ministries, departments and agencies, as well as oil companies also deduct value-added tax at source and remit to government coffers. It is this automation that is now being extended to the power sector post-privatization.
On Tuesday, 24th of June 2014, stakeholders from both sides of the divide came together to chart the way forward.
Nigerians must have to understand that they have to pay for energy as at when due to be able to meet the investment requirements of the new owners in this electricity market. But more important is the fact that the tax regime and the tax thinking for the new owners must be in line with the federal land revenue expectations. That's why we are here, and we want to ensure that the assets are not just bought where there's a new approach or creative models of evading tax. We're supporting the federal land revenue completely by pushing to create an automated process. As much as we've privatized, we do not want monies that is due the federal government not to come to the federal government based on our own lapses in the ministry.
NERC is committed, truly committed to making sure that VAT is recovered per every kilowatt hour that a consumer collects. It has to be a line item on the bill. Technology can help us get there. If FIRS works with NERC, NERC works with the operators, we can certainly implement technologies that make sure that collection of VAT, collection of regulatory fees, all the other services that are paid for are clearly delineated as line items on the bill, and you get your money remitted clearly to you.
The workshop was graced by the acting executive chairman of the FIRS, as well as the permanent secretary, Federal Ministry of Finance, who stood in for the Honorable Minister of Finance and Coordinating Minister of the Economy. Mr. Shuaibu Abubakar, also of the Nigerian Electricity Regulatory Commission, gave an insight into the current method of the collection of VAT from electricity consumers.
The customers buy electricity at approved tariffs plus 5% VAT. What this means is that the tariffs approved by the Commission to be collected by the distribution company does not include VAT. The VAT element is added at the point of purchase. The VAT are not included at the generation, transmission, and distribution. It's actually added as a value added, to the cost of the electricity that has been approved.
However, the gas suppliers actually add VAT in the invoice that is sent to the generation companies.
Mr. Olufemi Fani of the FIRS made a presentation on the proposed new method for the collection of VAT in the Nigerian electricity supply industry.
The acting chairman of FIRS, when he was delivering his keynote address, mentioned about certain forays and progress we have made in the area of automation through technology of capturing VAT, because we are always looking forward to progressing, improving in line with best practices worldwide, that we are now capturing VAT in the aviation sector direct, and in the financial sector of the economy too. We are making so much progress in that regard, and telecommunications, we have almost wrapped that up. And that is largely helped by the fact that there's no talk of input VAT from the aforementioned, from the explanation that I've made from the position of the law. Now, the specific implications for the power sector now. Therefore, input VAT, the power sector is not qualified for input VAT deduction. Now, another implication in the emergent sector now, especially as it concerns the unbundled entities, is that they have to register and they have to be filing regularly, latest by the 21st of the following month, like I said. Now, each unbundled entity is to file returns at the tax office of jurisdiction. Each entity, each company, if you like. Each unbundled entity, therefore, is to register and obtain TIN in that regard. Each unbundled entity is to file, of course, the subject matter here is VAT, but we cannot go without touching on the need also to file for companies income tax and education tax.
At the end of a robust discussion of the proposed new method, a communique was issued that capital items as defined under IFRS should have the value-added tax paid on them capitalized, that gas purchases and other items, such as bulk power purchased, which are invoiced for value-added tax, will need to be treated under some special dispensation to be worked out between the Federal Inland Revenue Service and the Nigerian Electricity Regulatory Commission. That there will be a single point of collection of value-added tax. That while a special dispensation is being considered as stated above, value-added tax collected and being collected now should be remitted on or before Monday 30th June 2014 for that already collected, and promptly otherwise without prejudice to any agreement needed on eligibility of refunds.
It is hoped that with the spread of automation across the entire tax collection terrain, more revenue will flow into government coffers at all levels, and that those different governments will be in a better position to deliver on what the citizenry expects from government, all with a view to making us achieve the better society of our dream. We thank you most sincerely for watching today's episode of the program, and we are enjoying you to join us next week for a fresh episode of Tax Matters. From Christina,
thank you for watching and bye for now.
Have a blessed week ahead.